Hello, I'm Chase Carmichael. I work as the Director of Institutional Client Relations at Eagle Asset Management in the St. Petersburg, Tampa area. Today I will be meeting with Mr. David Wood, the Managing Director for Hyde Park Capital, to discuss Eagle Asset Management's Small Cap Growth Fund. Through Hyde Park Capital, Mr. Wood manages millions of dollars of his clients' money and has currently been underperforming the market due to his risk-averse investment strategy. In 2009, Mr. Wood lost a lot of capital during the financial collapse of 2008 when collateralized debt obligations lost all their value due to many homeowners defaulting on their mortgages. Since then, Mr. Woods has been primarily invested in fixed income instruments and low-risk blue-chip stocks. I'm here today to convince Mr. Woods that my small cap growth fund will provide him with the higher returns he needs, coupled with a disciplined risk management strategy to protect his client's capital. Mr. Wood's communication style is driver. He is quick to the point, all about the facts, and impatient. I must be careful to listen clearly to all his questions and be mindful of not wasting his time with needless information. For this one-on-one sales call, I will assume that Mr. Woods and I have had a brief conversation over the phone prior to this meeting. I am now meeting with Mr. Woods at his office in Tampa, Florida to try and obtain his business. The stated objections I have been assigned are compare, contrast, and direct denial. I will also be using an additional selling point close. Now on to the sales call.
Please come in.
Hey, how are you doing today? I'm Chase Carmichael with Eagle Asset Management.
Dave Woods from Hyde Park Capital. Please have a seat.
That is a nice mahi-mahi right there. Where'd you catch it?
Off the coast of the Florida Keys.
No better place to go deep water fishing, I've always said. My parents actually have a place in Marathon Key.
That's nice. Marathon is actually one of my favorite keys, as it is best for fishing. Enough about fishing, though. We are here for business.
Agreed, Mr. Wood. We're both very busy men. Now on to business. I'd like to begin our meeting today with a brief background of my company, Eagle Asset Management. It is a subsidiary of Raymond James Financial and was founded in 1976. It provides investment management services to both institutional and individual investors alike. Eagle Asset provides both equity and fixed income products for long-term investment horizons. With more than $31.3 billion in assets under management entrusted by its clients, Eagle strives to provide returns that exceed the benchmark index, the Russell 2000, while providing less risk. Now I'd like to tell you a little bit about myself and my history in the financial industry. I graduated cum laude from the University of Florida in 2003 with my finance degree. I then went straight to work for Eagle Asset as an analyst for the Small Cap Growth Fund. Researching and trading small cap stocks has always been a passion of mine since junior year of college, when I started trading my own account. Finding deeply discounted stocks of unknown companies with great management and innovative products has long been a strategy of mine that has led to my success in the small cap stock sector. Using this strategy, I became the portfolio manager of the Small Cap Growth Fund at Eagle Asset at the end of 2008. As you well know, in late 2008, we had the beginnings of the collapse of the major financial institutions in America. Due to the over-leveraging of investments in collateralized debt obligations by these institutions, we had the beginnings of the housing crisis and the start of the greatest recession since the Great Depression. The reason I bring up the crash of '08 is because as an aftermath of the crisis, most of the small cap companies I had been invested in dropped steeply in price. Most of them dropped in valuation not because of their own doing, but because of the bleak economic climate these emerging companies were exposed to. '08 and '09 were the two toughest years I've ever had in the investing world. But I believe that a man is measured not by the magnitude of his failure, but by the magnitude with which he responds to that failure. In the 5 years that preceded, I was able to generate an average annualized return of 24%, slightly outperforming the Russell 2000 index. In August of 2013, my wife brought in our firstborn into this world, and I knew that I no longer could devote as much time as I had in the past to successfully managing a portfolio. So at the end of 2013, I was moved to Institutional Client Relations team, where I now work as our relationship manager for the Small Cap Growth Fund. Now, Mr. Woods, I'm going to cut straight to the chase in the interest of saving both of us the time. I know that like most in the business of investing, you too had your portfolio turned inside out as a result of the crash of '08. Am I correct in that statement?
That's correct, Mr. Carmichael.
I also imagine that your clients were not very thrilled either, and I bet that, like me, you also had many a sleepless night. worrying about the future of your client's money and your business. Am I right, Mr. Woods?
Yes, indeed. Those were hard times.
And how did you respond to that situation?
I took the capital I had left and shifted it to safer havens, such as fixed income instruments, ensuring that my client's capital was safe. When the market started making a comeback, I slowly started shifting some of that capital over to low risk blue chip stocks.
Based on the conversation we had over the phone, Mr. Woods, it sounded like your clients are now demanding higher returns.
That's correct, Mr. Carmichael.
And you are open to the idea of higher risk-adjusted returns?
That is why we are here today.
Yet, like all great investors, you know that any quality investment starts and ends with a quality management team.
That's exactly right.
So if I'm not mistaken, Mr. Woods, what you're exactly looking for in a mutual fund is a fund that can provide experience and higher returns on a risk-adjusted basis, all at a price that won't limit your returns.
That's correct.
I believe then that Eagle Asset may be of great service to you personally. If you do not mind, Mr. Woods, I would like to show you what my business could offer to you.
Please proceed, Mr. Carmichael.
As we both agree, great management can turn a mediocre product into millions, while mediocre management can squander even the best opportunities. At Eagle Asset, we have a team of portfolio managers with an average investment experience of 25 years between them. Also, our portfolio managers have an average firm tenure of a decade or more. Comparatively, other firms only have an average firm tenure of 3 to 4 years. Many of our guys have been through all of it, from the dot-com bubble of the 90s to the housing credit boom of the 05 to 07, all the way up to the crash of 08. In fact, one of my longtime friends and mentors at Eagle Asset has recently taken back over the portfolio manager role of the Small Cap Growth Fund. Bert Boakson assumed the role as first portfolio manager of the Small Cap Growth Fund back in 1994. He stayed in that role until the end of 2008 when I took over for 5 years, until, due to family obligations, I had to move to client relations. Bert gladly took that opportunity to resume the role of managing the Small Cap Growth Fund portfolio, something he had missed dearly. Bert is one of the best portfolio managers that Eagle Asset employs. As proof of the fund's success under his direction and mine, I have brought a table as value analysis detailing the fund's performance relative to the Russell 2000 index. And as you can see, in years 5 and 10, we were able to generate a return that outperformed the benchmark index of the Russell 2000. These returns clearly show that Eagle Asset can provide the best return on investment over the longer term, outperforming the benchmark and our top competitors. Do you believe that Eagle Asset Small Cap Growth Fund can provide the experience and returns you are looking for?
I do, yes.
Would you like to go ahead and make a small initial investment of $10 million then?
Mr. Carmichael, as you well know, 2008 and 2009 taught us as investors many lessons. The biggest lesson I've taken away from that collapse was due diligence and more due diligence. Before I can even start talking numbers with you, I am going to need to know more about what your company can provide and specifically prove to me why I should invest in your fund over the Wells Fargo Small Cap Growth Fund.
I fully understand and respect your hesitation. Any investor worth his salt makes sure he knows exactly what he is getting into before he makes an investment. Now, if I fully understand your objection, you need to learn more about my company relative to our competition before you can make an investment decision.
That's correct, Mr. Carmichael.
Well, Mr. Woods, if we take a look back over this table, you will see that while we have underperformed relative to Wells Fargo in the last year, we have consistently been able to generate returns over the longer term, 10 plus years, and in addition, we have a lower fixed fee percentage of 2% versus the 2.5% that Wells Fargo employs. As all us investors know, the fixed fees are what kills mutual fund investors' returns over the long run. On top of our higher long-term returns and lower fixed fees, our small cap fund in particular provides much more in the realm of management experience, which we both believe is the most important quality of any business. Our portfolio manager, Bert Boakson, has been with the fund since its inception and has had proven results in the small cap market. Our competition just cannot provide the same kind of management experience when the average turnover is 3 to 4 years. Have I helped calm your concerns relating to our experience and past performance?
Yes, I believe you have done a thorough job providing your fund's qualifications thus far.
Mr. Woods, if I may then, I would like for you and I to take a step inside the investment process that has generated years of success for this fund. Mr. Woods, what is one of your greatest concerns when it comes to investing in small cap stocks?
Well, Chase, the elevated levels of risk associated with investing in small businesses, of which 9 out of 10 fail their first year.
Correct. How do we compensate for these higher elevated levels of risk?
A superior risk management strategy.
Exactly. As my mentor and head of the small cap fund taught me early on, diversification is important, but what is even more important is knowing when to sell your losers and knowing when to add to your winners. And how to tell the difference between the two. At Eagle Asset Management, the key to our success and the biggest benefit to our clients is, in fact, our risk management plan. In an industry in which less than 1% of businesses excel in the long term, you are inevitably going to pick losers. In the small cap market, a fund's success begins and ends with having a proven risk management plan in place that limits losses and maximizes gains. Our small cap growth fund accomplishes these things through two main components: diversification and sell discipline. Here, as you can see on our fact sheet, our top 10 holdings make up only 21.5% of our total portfolio. We readjust our positions on a quarterly basis to make sure we do not become overweight in any one position. In addition, we make sure to identify and stick to and add to our winners accordingly. Through our second risk management component, sell discipline, we have teams of analysts assigned to different stocks constantly monitoring their financial condition. As a stock becomes a candidate for sale, if its fundamentals or competitive landscape change, the original thesis is proven incorrect, or the position becomes overweighted relative to the rest of the portfolio. Our small cap growth fund would not have generated the returns it did had it not been for the risk management plan we had in place. Risk management is a number one predictor of success in the small cap stock sector, and I believe our 5 to 10 year investment returns prove that. Furthermore, now that you have had a look into our investment process of our fund, do you agree that our fund provides a superior risk management strategy as evidenced through my value analysis of the fund's performance?
I do, Mr. Carmichael.
Now, would you be willing to start talking numbers regarding an initial investment, Mr. Woods?
I wish I could, Mr. Carmichael, but I still have one concern. I have been hearing a lot lately that the small cap sector is in a bubble currently. Look at your own fund's returns and the returns of the Russell 2000 index over the past 5 years, 24% and 21% respectively. Just look at 2013, 43.5% in returns for the Russell 2000. These gains have been immense. While I agree with you that your fund is everything I'm looking for, Mr. Carmichael, I am worried that the pile of cards will come crashing down to the ground again.
Mr. Woods, I definitely see the cause for your concern. If I understand you correctly, you are worried about a potential bubble forming in the small cap stock sector.
That's correct.
I see. Yes, the Russell 2000 has experienced great returns in the past 5 years. And yes, it is a stock picker's game right now, more than ever. But there are many small cap companies that are still unknown and are still undervalued. While the PE valuations for the sectors have become high, I do think that risk can be managed through the discovery of up-and-coming sectors and subsectors, such as the rare earth miners or the regenerative tissue biotechnology sector. And remember, Mr. Woods, most importantly, we care about our long-term 10-year plus returns. We worry less about our performance limited to a yearly basis. I still have a long-term bullish view for the small cap stock sector and believe that the small cap industry as a whole is not in bubble territory. At the end of the day, Mr. Woods, our risk management strategy will protect us from the collapse of collapsing subsectors. Have I helped suppress your fears about a possible bubble in the small cap sector, or at least proven to you our ability to manage these risks?
Yes, you have.
Mr. Woods, if I may, I would like to summarize what we have learned today during this meeting. You sought me out looking for higher risk-adjusted returns. I believe I have fully demonstrated my management team's high level of experience proven through consistent long-term returns. Also, I believe that our risk management strategy has been proven superior compared to our competition. Am I correct in saying this?
Yes, that is correct.
As a final point, Mr. Woods, I would like to give my clients my own personal cell and home phone number.
Thank you.
And I don't want you to think of me just as a business associate, Mr. Woods, but as a friend as well. In the end, I make money when you make money. Are you ready to make some money, Mr. Woods?
First off, Chase, friends call each other by their first names, so let's try that again.
I'm sorry, Dave. Can I interest you in making a $10 million initial investment in our fund, friend?
Just show me where to sign.
right here. Thank you for having me today, Dave. I'm excited about what the future holds for us.
Me too. Thank you.